So we carry on with the banks today on Breakingviews. Lloyds looks ready to sell shares. The snag, Barclays' $9 billion rights issue could suck up demand. And SocGen comes back fighting in Q2. The market certainly likes what it heard. Reuters Breakingviews banking columnist George Hay joins me. Let's start with Lloyds and Barclays. There's been a lot of talk this week on the back of the Barclays rights issue announcement that this is going to suck up shares and it's going to be tough for Lloyds. Are we over-egging that a little bit?
I mean, obviously it depends when Barclays moves. It's looking probably like September or October when they'll get their rights issue underway. Could be a little bit before that, but the key thing is they're doing a rights issue. What Lloyds is probably going to do, we don't know yet, but what it's probably going to do is just a kind of accelerated sale of a small chunk of the government stake, which you can technically do very quickly. You could do it in a day if you kind of get all your ducks in a row. So that's kind of why we're making this point, that now that Lloyds is looking really quite good on a financial basis, if the government wants to get its process underway, then there doesn't seem to be too much stopping it other than what the regulator feels about Lloyds' capital. Lloyds' capital now is almost 10%.
But okay, so there's nothing stopping it. But you're saying that the Barclays issue comes at a bad time for Lloyds because investors are going to be more, or investors are going to start sucking up those shares and won't suck up the Lloyds shares. I mean, I don't quite see why.
That's more kind of what the market is kind of has been saying recently. But,
do you believe that?
Well, it's potentially. It just depends who goes first. That's the thing. If Lloyds just managed to do what you call an accelerated book build process, where they just basically sell the shares very quickly to a load of institutions. These institutions are just, big pots of money who want to invest it in banks at the moment, and they can either invest it in Lloyds or Barclays. Now, so clearly, if Lloyds goes first, then the problem would be more a problem for Barclays. So it's really just a question of who goes first.
So these big, sorry, maybe I'm being incredibly naive, but these big institutions aren't. They're not a little bit more picky. They're not saying, look, we're going to invest in Lloyds for this reason, we're going to invest in Barclays for this reason.
Well, generally they'll be big.
Or we can invest in both.
They may well want to just invest in both, and that it will depend on how they're feeling in a couple of months. But I mean, generally speaking, if you're a fund manager at the moment, you'll be looking and saying, well, okay, I have this. I've got to invest in something, and it's a straight choice between Lloyds and Barclays.
Okay.
But it's also down to which one goes first, isn't
it? All right. Okay. You've just about sold me on that. I guess the reason I'm saying is because we've been talking about it all week, and we had some guy from Accenture and saying, actually, if you're going to buy Barclays, you buy Barclays. You're going to buy Lloyds, you buy Lloyds. But I guess we'll wait and see. SocGen, the market likes what it heard. We're up about 7-8%. This is a bank that's hitting its targets, which I guess is what banks really need to be doing right now.
Well, yeah. I mean, obviously, there's the uncertainty of when we're going to come out of QE, and that's hit a lot of banks' results in the second quarter. With SocGen, they've kind of managed to weather the worst of that. Their fixed income trading wasn't too bad. Performance wasn't too bad compared to others. And the key thing is that they're still committing to their target at the end of the year, which is to get to 9.5 or around there percent on a core tier 1 basis on a Basel 3 level, which is the kind of gold standard for all banks. They're committing to that, and I think they're getting the credit for that.
Just a quick final sort of general comment. As the banking columnist, or one of the banking columnists, we've had a raft of banking earnings this week. What is your general feeling? Is it are you pleasantly surprised?
I think
without wanting to put words in your mouth.
Well, no, I think. I wouldn't go as far as pleasantly surprised. I mean, it's been interesting to see how some of the investment banks have done better than others in their fixed income trading. Clearly, this is the part of their business which is particularly going to be affected by uncertainties about when we're going to come out of QE. That's kind of the big picture. Now, some of them have done a lot better than others. Obviously, that's because some of them have different business models to others. But generally, it's not been quite as disastrous as people might have thought.
All right. Good. George, thanks very much indeed. George Hay. For more agenda setting insight, watch our US Breakingviews show every day, 12:30 Eastern, 17:30 BST. I'm Axel Threlfall. This is Reuters.